Hello, Philip. How are you?
I'm well, Danny. I'm very well, thank you. And you?
Great. And where are you? If
I
I
am in Ottawa, Canada.
Nice, nice. So I'm very happy to have you here, and I will introduce you in a couple of minutes. I just wanted to ask you, maybe right just before that, how are things over there right now with COVID and everything around that?
Well, thank you for asking. And fortunately, in Ottawa, things are remarkably benign right now, and we're keeping our fingers crossed. There are other parts of the country which are much more stressed, but we are in a fortunate location, and things have touch wood, have been okay.
Okay, because yeah, as you know, we monitor what's going on in Canada. We're doing events in Montreal and Toronto, and there I hear things are not, cases are growing. So we're just keeping. And I understand that the government is pretty still strict about the regulation and the restrictions.
Yes, well, certainly a lot depends on the province. It's province by province. But in Ontario and Quebec, I would generally say that they have been stricter, and that has paid dividends in terms of case counts and what have you. Unfortunately, right now the hotspot is Alberta, and to a lesser extent Saskatchewan, where they're having a very dangerous spike with ICUs filling up and what have you. But for now, we seem to be okay, so we keep our fingers crossed. Masks on.
So thank you very much for being with us here today. So obviously, we're going to talk about a special, interesting way to look at the hedged equity. We're going to talk about using short and long volatility equity investments to create low correlated diversified portfolio with risk efficient returns. Couple of words about you, Philip. You've been active in global markets for over 30 years, spent over a decade with JP Morgan, structuring and trading risk management products across a variety of asset classes. At the same time, managed macro and commodity strategies as an asset manager and fund of funds manager. Philip was also founding investor in Beta Pro Management, which eventually became Horizon's exchange traded funds and grew to over 5 billion in assets under management. By the way, we know Horizon, and they have been presenting at our events for several years. Philip earned a Bachelor of Economics from Mount Allison University in '89 and a graduate degree from the Georgetown University School of Foreign Services in Washington, D.C. in '91. Can you tell us a little bit just before we start, so what it is you guys do, and what are you doing currently at your firm today?
Well, we'll get into it certainly in the presentation, but we're a very small firm, and we have one strategy, which is what you're going to hear about today, one pooled fund. It's an exempt market fund in Canada for accredited investors only. So we have a very focused effort on that one fund and that one strategy that has been my singular focus the last 3.5 years. And we had 3 years of testing the strategy, we believe successfully. So its proof of concept is there with real money. And so this year we started to try to market and build out our presence.
Thank you. So I believe we'll start with a presentation. Then I have some questions for you about what you'll be showing us here, and we'll take it from there.
Super. Should I share my screen?
Please.
Okay, here we go. Do you see that?
Yep.
Okay.
But we're seeing the presentation, but we also see the side of it. No notes, display settings, all of that.
Okay. Here, you know what? We're just gonna X out of the
yeah.
Screen sharing stopped. So we had that open for our test before. We'll just try this again.
Sure. Great.
Okay, and now we'll just go to full screen and hopefully we'll all be there. How's that?
Great. So now we're going to hear a little bit about investment partners and your strategies.
Okay, and
Thank
off we
you.
go. And thank you, Denny, and all of Rachel's efforts, and thank you everybody for tuning in today. I've got a presentation of approximately half an hour in duration. I'll try to keep it snappy and focused, and then Denny will no doubt grill me with some good questions afterwards. So very briefly about us, Denny very kindly already made the introduction, so I won't go much further into my background, but we are a small shop of 5 people, 4 full-time, dedicated to this fund and building out this business. It has been my sole focus for 3.5 years to work on this strategy, and we, after 3 years, felt we reached a level of success that we built out our team and are now looking to expand the business. We are based in Ottawa. The management company has existed for over 10 years under prior management, but that previous strategy was finished and replaced with the one we're going to talk about today, which, as I say, has been in existence for 3.5 years. We have 18 million Canadian under management. Again, we were in this test phase for 3 years, and now we're looking to build it out. Our client base is a core constituency of Ottawa high net worth clients who have been very supportive of our company for several years. There's 3 parts to the presentation today, 3 short parts. We'll start with a brief performance overview, then we'll talk about portfolio construction, and lastly, some arguments on why we believe hedging is sensible in the current environment. So first, a high-level view. The fund is an equity fund with the objective of delivering a higher return, a higher quality, lower risk, and index-agnostic return stream. And through the presentation, we compare ourselves to the S&P total return and the TSX total return, simply because those are transparent benchmarks, which everybody's very familiar with. Clearly, a hedge strategy is different from what's in those in the indices, which don't hedge, but they do reflect what a lot of people are invested in. The fund itself has value-oriented long holdings, and then it has an active options-based risk management strategy alongside. We believe, and hopefully you'll concur at the end of this, that it is quite a conservative approach. We offer monthly liquidity on 5 business days notice. We use no leverage to speak of. We never extend more capital than we have in the fund. In terms of key performance metrics, we highlight them here on this page, and there's detail in the appendix. And I should mention, we will make the presentation, a hard copy, available to you following the presentation today. And we have detailed analytics in the appendix. Some of the high-level results you see here, again, compared to the S&P and the TSX over the 3.5+ years that we've been in existence with this strategy. I'd highlight that our volatility has been less than half that of the benchmark indices. Our max drawdown has been about half that of the major indices. And very importantly, we're going to come back to this later, our correlation to the equity indices is virtually 0. And that is critical for some of the things that I'll describe later on in the presentation. So I think the first question that people have with a hedged equity strategy is, how have you done when the market's gone down? Which is a logical question. So during this time frame, there has been 2 significant declines. One was in the 4th quarter of 2018 on the left-hand side of the page, and the other was, of course, with the Feb-March COVID decline in Feb-March 2020. And I'd like to walk through each one of these the better to help people understand what goes on below the surface of the strategy. So looking first on the left-hand side at 2018, and this graph tracks out from when the S&P 500 peaked, which was right at the end of September of that year, to when it troughed, which was in fact Christmas Eve of that year. For the first 2 months of that decline, up until the point of the vertical red dashed line, nothing much happened. The indices were off 5%, we were off 5%, nothing to see here. And what's important from this is to highlight that we are not trying to remove every little swiggle down in the market. We are trying to truncate the extreme left side of the distribution. And so when the market really rolled over quite hard in December of that year, you can see that the indices declined precipitously, but the IP fund only declined a little bit more. And that was very much our hedges kicking in. Rolling the clock forward to March of 2020, we had somewhat of a different lead up to the decline in the S&P. And again, this tracks from when the S&P peaked to when it troughed. Coming into the peak of the market, we were quite tightly hedged because the markets were quite overbought, quite extended, which is naturally an environment where we will be more tightly hedged. So combined with that, or we were just naturally more tightly hedged, the pandemic was interesting because we saw something happening progressively getting worse. And look, I had no idea how severe the pandemic was going to be, and I'm not going to pretend that I did. But we saw the virus pop up in China. Next thing you know, it was in Iran, and then it was in Italy and in Spain. As that happened, naturally, the risk environment was getting more acute. And so we dialed up our hedges and dialed up our hedges, such that when the markets actually finally rolled over, we were in great shape. And we did fine. What's interesting here from an instructive view about the strategy is looking now again at the vertical dashed line, you can see that we lost a little bit of money at the end of the decline in tandem with the indices. And this is a reflection of more aggressive monetization of our hedges. The thing about hedges, they're like insurance policies. At a certain point, they get monetized if they're in the money. They have to be monetized if they're in the money. The question is, how aggressively as a manager do I choose to do that? All the way down the decline, we were monetizing, but we got more aggressive at the end as it became apparent that the market was getting very washed out. And that's what was going on here. We still had protection. We just had less protection than we did earlier on. So I'd now like to discuss a little bit portfolio construction. To begin, I think it's important to understand the philosophy that is driving our approach to doing this, because that is what ultimately defines the portfolio construction approach. When we look at traditional investment allocation, it's almost always siloed by asset class. And you see them listed there, and you can certainly bucket others in there. These are some of the major ones that we're all familiar with. What's interesting about the traditional investment buckets is, as a derivatives trader, I look at them as all being effectively short volatility. They do well under circumstances of equilibrium, of economic growth being gradual and a long trend, of normalcy. They tend to falter when there are excursions from normalcy, deviations from normalcy. They're hurt by weak and turbulent markets typically, and thus I look at them as being effectively short volatility. So to hedge a short volatility position, which in our case is in the equity bucket, we really need to think about being long volatility to offset the short volatility position. So what we do at the IP fund is to match off, to diversify the short volatility of the long equity portfolio that we're in. We get long volatility through long options. There's arguments to be made that there are other strategies that also provide long volatility exposure, most notably global macro and systematic trend strategies, both of which in differing ways try to capture trend moves up or down in different asset classes. They're directionally agnostic, and thus they tend to capture volatility fairly well. We use options because that's our stock and trade. But by having the two together, we create a genuinely balanced portfolio. Long volatility provides meaningful diversification to the inherent short volatility of a stock portfolio. And I should immediately identify that this is a thought paradigm that has been quite extensively developed and researched by a fellow by the name of Chris Cole, who runs Artemis Capital Management in Austin, Texas. And you can go to his website, and he's got some publications there that are free to access where he expounds on the role of volatility as an asset class. And it is a very compelling reading, and it's very much an approach that I subscribe to. So what does this imply for our portfolio construction? Well, very simply, we have two portfolios. We have a core book of North American stocks, primarily North American stocks, with a value bent, and that's the engine for long-term growth. And then in tandem, we have a hedge portfolio, which is actively managed to manage on a tactical basis market exposure and reduce systematic risk. And I'll talk about each one of these in turn. The core portfolio, we divide really into two buckets: anchor investments and thematic investments. Anchor investments tend to be ones that we hope to hold for a long time. They're companies that are good at compounding and their capital. And ideally, if we can purchase them during sell-offs, we can also benefit from a catch-up if we buy them at a discount to true economic value. There are also companies that tend to be easily hedged by systematic hedges because they're big companies. And companies we put in this bucket in our portfolio include Berkshire Hathaway, Fairfax Financial, and Brookfield Asset. Our other bucket is thematic investments, and that is a bit more top-down, where we are looking to capitalize upon the revaluation of a sector or an industry, and we're taking more diversified exposure typically, and hope to benefit from the revaluation through the full cycle. So themes that we've played with some success in recent past or presently include the commodities markets resurgency, the renewables, growth in the renewables industry, the U.S. cannabis industry, the U.S. defense industry, and presently one position that our most recent one is the European energy super majors. In terms of what the portfolio looks like from a valuation perspective is pictured here on the left side of page 15. And what we do here very simply is using two metrics: next 12-month EV to EBITDA, enterprise value to earnings before interest, taxes, depreciation, amortization, and next 12-month price earnings. We compare ourselves to the S&P 500 in the middle bar and the FANMAG or the FANGs or whatever your preferred acronym is for the mega cap tech stocks. One bit of statistical sleight of hand that we admit to right away here is for our portfolio, we throw at the two highest observations because we have mining explorers and cannabis companies with very, very low multiples. And we also throw out the two bottom, the two cheapest, to get a more centralized statistical observation. And that's what you see portrayed here. The fund is very value orientated, although there are some growth components, for instance, the US cannabis industry. One aspect to it, value investment is broadly understood. One aspect to it, though, that we emphasize, which is very important to our approach, is what we call committed management. We look for companies that are ideally still run by their founders, and where the founders are not getting rid of stock, but accumulating stock when they can. I love those situations because you can sleep better at night knowing that they are stewarding their own capital very seriously. And there's detail on the portfolio in the appendix I'd be happy to discuss after the presentation. Turning to the hedge portfolio, there's several aspects to it that are critical to understand. First of all, it is a limited risk approach. We are only at risk for capital that we commit to the hedge portfolio because we are net buyers of optionality. We do sometimes sell optionality, but only in spread form and combinations, where the risk is defined ahead of time. In aggregate, the portfolio is limited risk. Second, it's index-based. The vast preponderance of the hedges are on the S&P 500 or the NDX 100. And what's important about that is, first of all, those are two of the most liquid markets in the world. So we get tremendous flexibility and very efficient pricing in those markets. But second, their index approaches were using the options to strip out systematic risk. We are still vulnerable to idiosyncratic risk if one of our particular holdings has an adverse event. The third feature of the hedge book is that there is a portfolio approach. We're not buying one option for a certain date, a certain strike, and sitting back and seeing what happens. What we're doing is constructing a portfolio of options that creates all of the partial exposures that address the sensitivities that we are most concerned about at a given point in time. We are constantly running sensitivities, seeing what the distribution of outcomes is in our portfolio, and then reshaping the hedge portfolio to steer away from the worst tails. And that requires an assessment of all the different partial exposures and how the portfolio will behave through time. It's constantly being adapted to market conditions. As market conditions change, as our interpretation of risk changes, we're tweaking it. And what's very important to understand is while our core portfolio is very stable, it's very low turnover, we're long-term investors, the hedge portfolio is very dynamic and is getting very actively managed. The other reason it needs to be actively managed is to manage cost, because as you might imagine, owning options is like owning insurance. The biggest risk in that approach is the constant grind of time decay that works against you. And so you need to work aggressively and proactively to manage that. The objective of this approach is, as I mentioned, the reduction in systematic risk and to get asymmetric and convex returns. Let me illustrate what I mean by that. Here we have a static look of our portfolio a few days ago and looking at how the various components behave under different market circumstances. If you look at the x-axis, it shows the change in the market, and the vertical y-axis is the P&L. Well, our core portfolio, assuming a beta of 1, which we do for this analysis to simplify, has, as you would expect, a linear outcome. And when this was 1, we were about 70% long. And so you go down 10%, you lose 7%, you go up 10%, you make 7%. If you add to this our hedge portfolio, you get this profile of the hedge book, which is, as mentioned, convex and asymmetric. We are looking for big payouts in an extreme adverse event, but we're also looking for convexity in both directions, because ultimately we don't pretend to know what the market's going to do, and we have to be prepared for all outcomes. Notwithstanding that it's a hedge portfolio, we have to manage under the assumption that anything is going to happen, and we need to be prepared for that. When you combine the two portfolios, you get the heavy green line, which is the net exposure. Now, this is a snapshot in time, and it only reflects change in price. There are other components to valuation of the hedge portfolio, most notably volatility, that impact the shape of this line, and the line moves through time. So it's a very static snapshot, but hopefully it gives you a sense of what the impact of the hedge portfolio on the core portfolio does in terms of mitigating the risk profile. I'd lastly like to spend a few moments on the hedging rationale, why we believe hedging is important. I told you about why we think hedging with options in terms of owning volatility is a wise way to do it. But I want to explore why we think hedging is important at this juncture, because I think that also explains the role that we think we play in investors' portfolios. And there's really 3 reasons that we hedge equity market risk. Protection from high valuations, the improvement of the risk-return characteristics of the portfolio itself, and lastly, the beneficial portfolio effects this approach can have when it is added to a broader portfolio of equity market risk. And I'm going to explore each one of these in turn. So our first argument for hedging is that we are of the belief that current equity market valuations are very high, and thus there is the risk, a larger risk, of a substantial and prolonged decline. Ultimately, at the end of the day, the return you get is a function of the price you pay, and the price we're paying right now for equities at an index level is very high. I spent a lot of time doing a lot of readings, I'm sure everybody else does, trying to gather different points of view, and many reputable investors of long standing have come to similar conclusions. And I mentioned research affiliates, Grantham, Mayer, Van Otterlo, big banks, Bank of America, the list goes on, of people who have reached the same conclusion. And on the right-hand side, and there's oodles of research you can find on this, but this is a very simplified representation from Bank of America, which shows that with the current normalized PE where it is, the forward-looking price returns on a 10-year time horizon are pretty much zero. And there are people, notably GMO, who have even more negative outlooks. There's a couple of important things to remember. First of all, valuation is not a timing tool. So it tells you field position. It doesn't tell you which way the ball is traveling. And we have to accept, as I alluded to earlier, that just because the market is overvalued, it doesn't mean it needs to go down tomorrow or next week or next month or next year. I would just say that the probability you attach to that presently is higher. One question I ask myself when I see a lot of people reaching the same conclusion is, do we have a case of groupthink going on? Are we all being led down the primrose path by an inability to think outside the box? So standing back and asking myself, how is this analysis wrong? How could it be wrong? I come to two conclusions. First of all, most of these valuation analyses look at historical multiples. They'll look at 25, 50, even 100 years of data to come up with a valuation norm, and they'll assume mean reversion to that norm over time. To use the four most expensive words in investing, this time it's different. The only way you can argue that these valuations, these approaches are not valid is to say this time it's different and historical valuation metrics don't matter. So that's one way this is wrong, if historical valuation metrics don't matter. The second way this could be wrong is if we suddenly ascend to a higher GDP growth trajectory, which would have presumably good result for corporate profits, earnings, and would normalize the valuations quickly by growing results. The problem with that aspiration, and believe me, I hope for it because our collective wealth and well-being hinges on strong GDP growth. So I root for this outcome, but I'm skeptical, and I'm skeptical for two reasons. One, demographics. GDP growth is a function of two things: labor force growth and productivity growth. Labor force growth, we know with substantial certainty, demography is very accurate, that we're not going to get great labor force growth. So then if we think about productivity growth, that's been downtrending, unfortunately, for decades. And it can be improved, but it can be improved with investments which take a long time to yield results, notably R&D, capital, human capital formation. All of that can contribute to a higher trajectory of GDP growth, but it will take a very long time to be realized. And so on net, I think these analyses are right, that the market's generally overvalued. Thus, we should have some hedge in our equity approach. So diving into the second reason we believe that one should hedge, I have a very simple little exercise for you, which is to look at two return streams, return stream A and return stream B, and ask you to choose one. Now, you might well anticipate this is a loaded question, and we've skewed the data deliberately to come to a certain conclusion, but for illustrative purposes, I think it's powerful. First of all, the average annual return of return stream A is in fact substantially lower than B. And indeed, you look at them and you think, wow, B's got a whole string of double-digit returns, one little hiccup, or significant hiccup in the middle of it, but by and large, B looks a lot more exciting and the average is higher, and A looks pretty dull. Well, as you might anticipate, as I said, we cooked these numbers, whereas the arithmetic return stream favors B, the geometric return stream says that one should be indifferent between these two. The compound annual growth rate for the two return streams, the two portfolios, is identical. Furthermore, if you then adjust the results for volatility and try to look at return per unit of risk, A is vastly superior to B because of its stability. Now, this is an extreme example, and I want to emphasize that, but the point to be made is it's not about arithmetic returns, it's about geometric returns and volatility. And we believe that hedging to achieve a more stable return stream has beneficial long-term results in terms of risk efficiency. But there's another aspect related to this, which is just as B had this problem in the middle, that obscures the fact that if you need your capital in the middle of a big decline, you have a problem. I think with the tremendous run in the equity markets since the GFC, a lot of people have forgotten what happened twice since the turn of the millennium, so not a very long time horizon. Looking back, we had a 45% decline in the S&P after the tech bubble, and it took over 6 years to return on a total return basis to break even. And after the GFC peak, the peak prior to the GFC, it took over 4 years to return to break even. If one needs one's capital during this time horizon, one has a problem. And hedging can hopefully reduce the risk of prolonged capital impairment. So the last reason I want to touch on, and then I'll be finished with my prepared remarks, but the last thing I want to touch on is the last argument for hedging is the role that hedging can have in helping to meaningfully diversify an existing equity portfolio. So in the examples I'm going to show you, we're actually using real data, whereas I had the hypothetical data before. This is actual real data. So first, what we did was constructed an efficient frontier for the period January 2018 to August 2021, so the last 3.5 years plus, using the TSX and the S&P. And very simply looking at standard deviation on the x-axis and annual return on the y-axis. If you invested 100% in the TSX, you'd be at the bottom end of this curve with just under 10% return and about 15.5% vol. If you invested 100% in the S&P, you'd be the other extreme with about a 17% return and 17% vol. And all the other points in the middle where you gradually, from 100% TSX, reduce TSX and increase S&P, you create this efficient frontier. So those are retrospectively your most efficient outcomes using just those two investments. If I said to you, go back to January of 2018 and put 25% in the IP fund, this is what, and then alternate the balance, the remaining 75% between the S&P and the TSX. This is what happens to your efficient frontier. It shifts to the left by about 25%. And you might ask yourself, well, how can that be? That is because, and I mentioned at the outset, important feature of our results is one, our volatility running about half that of the two indices. And second, the fact that we're virtually non-correlated to the indices means that we have an enormous diversification benefit when added to an existing equity portfolio by reducing risk per return per unit of risk. Only if you had invested heavily in the S&P would you have a choice to make between a higher return, higher risk portfolio. But otherwise, further down the curve, you're looking at much more favorable outcomes when you have IP fund in the mix. So let's extend this analysis a little bit further and look at the Sharpe ratio. The Sharpe ratio is indexed here on the y-axis, the vertical axis, against various baskets of first of all, the TSX and S&P portfolio. So this is the TSX S&P Sharpe ratio. If you then add a 25% allocation to IPF, the whole curve shifts higher. For every basket of S&P and TSX, by adding IPF, you get a more efficient portfolio. Even though our CAGR has been lower than both of these over the time horizon under consideration, the fact that our volatility is much lower and our correlation is nil means that we impact meaningfully the efficiency of the overall portfolio to which we're added. So briefly, in summary, we've talked about the advantages of hedging, and I won't rehash those. I would like to make a brief comment about how you hedge and why that matters. And another reason that we use this approach is I am of the belief that after 35 to 40 years of brilliant performance from the balanced portfolio, that strategy at generationally low yields is getting quite exhausted. And you've all probably contemplated that yourself, so I won't belabor the point, but I certainly think that we've extracted most of the benefit from that approach at these yield levels. Second, long-short equity as an approach works in the hands of the small handful of extraordinary managers that do it well, but there's a small handful that do it well. the problem with long short equity is the open-ended risk of the short positions. And we saw that in spades earlier this year with the meme stock squeezes, GameStop, AMC, what have you, where very, very capable managers with very sound track records got really severely beaten up by these squeezes. And that's the problem with long short equities, the open-ended risk. Somebody once likened it to Russian roulette. It only takes one mistake to knock you out of the game. We think that hedging with volatility is a much more conservative approach because we're only risking committed premium and we do not use any leverage. It's a highly liquid approach because the S&P and NDX options markets are extremely liquid. We have tremendous ability to move our positions and to liquidate positions. That gives us capital in difficult markets. So in March of 2020, we were liquidating hedges and it gave us capital to deploy opportunistically when stocks were much cheaper. And lastly, as I mentioned, the existence of volatility in the portfolio creates a genuinely diversifying anti-correlative behavior, which we think is really important. And so the thought I'll leave you with is there's a famous quote attributed to Dorothy Parker, who was an American poet, which I'm sure you're all familiar with. Beauty is only skin deep, but ugly goes clean to the bone. Well, I heard the US hedge fund manager, Roy Niederhofer, come up with the investment corollary to this, which is returns are only skin deep, but correlation goes clean to the bone. And I leave you with that thought that we offer, because of our non-correlation, have an impact on equity portfolios, which goes well beyond just the top line, which is often everybody's focus. And I thank you for your time. And if Denny is still with us, he'll hopefully come back and pepper me with questions.
Of course.
There he is.
Thank you so much. We will, by the way, send all of this to you. It's all being recorded. Actually, you know what, before I'll start with my questions, when I was reading the some of the reports of the banks, they were all talking about everything's fine, the markets are solid, everything's great. And that was, throughout COVID. And, when I was a journalist, financial journalist covering 9/11 and other crises that had a lesser impact, right? Nothing was so global. The Chapter 11s and everything that came as a result was significantly worse than what we're seeing now. Even so, I understand the governments were putting money, saving some companies for a while, and that's about to end. And we're all going to pay taxes, right? Because of all of that, somebody will pay those bills. And it just doesn't make sense to me that such a huge catastrophe that is not even over yet. It's not like the battle is done and now let's count our dead. Unfortunately, it's a sentence that means actually literally what it says, but we're not even there yet. And things look bright, which is exactly brings me to your point where you say, things aren't bright. That's exactly my point. And, it's coming our way and we are going to be ready for that. So it just doesn't make sense for me that such a huge catastrophe, that I get it, that some earned from it, but very few, but all the rest are not there anymore. Shops are closing down. People will not have money to spend. I mean, how could such a big thing not have a huge impact on the markets? Not only didn't it have a huge impact on the markets, they keep on going like nothing happened. Something is fishy here. And if you can get out of the presentation mode so we can see you, and we'll send all the information, of course, to everybody who's here, how to contact you. So this is maybe a question that I didn't plan, but I really would love your thoughts on.
Well, it's a great question. So first of all, going back, I had a slide in there about how we had the drawdowns after the tech bubble and after the GFC took years to recover. The drawdown we had after the COVID crash took a question of months. And I think the answer very simply is not just the monetary, but the monetary and fiscal response, thankfully, after the onset of COVID was so fast and so huge that all financial assets recovered very quickly. And we've seen it. Look, it's not just equities. We see certainly in this country, and I think certainly now more in the United States as well, we're seeing real estate go through the roof. Credit spreads are within spitting distance of all-time tights. Liquidity has been extraordinary. So I think that would be my simple answer to the question. So then you say, okay, why should markets ever go down again? If monetary and fiscal authorities can always intervene, and I think that's a good question. Well, I think just as people make the argument about the monetary or fiscal put, which is now out there to a certain extent, I would argue that there's also a call which has been written over top of assets by the monetary and fiscal authorities, and nobody really admits to it, but we're starting to see the call get introduced just in the last few weeks, where the Fed has said, okay, we're going to start tapering, and you start to see, at the margin, liquidity start to contract. I think that the economic damage, certainly small business, which has been devastated, that will play out as the fiscal stimulus runs out. We're starting to see income support programs start to run out and what have you, and so that pain will start to stick, regrettably. So I don't think it's perpetual, and we've had this look. The patient was on the operating table, was given a huge shot of adrenaline and jumped to life, but that didn't really didn't necessarily solve all the problems, and we will see those. I think we'll see, if one believed that the support could be perpetuated forever, then, you shouldn't hedge. But I think that's, I think that to deny the existence of some economic equilibrium down the road would be aggressive.
Couple of questions. Okay, somebody's asking here, he had a major tech issue, he was cut twice. Was it on their side? Yes, it was on your side, because everything was well here. If we'll share a deck, this is all being recorded, and we will send you both the contact info of Philip and the recording. Now, couple of questions. What are the risks in your strategy? I mean,
very important. Very important. The risk in this strategy is, and I alluded to this briefly in the presentation, but it deserves more attention, is we are net long optionality, and we are paying for that optionality. It's just like you pay for insurance for your house and your car and what have you. And we face this constant chronic grind of time decay, where as time goes by, the value of the options naturally erodes. And that is the Achilles heel of this approach. To try to stay ahead of that decay, we are constantly, as I mentioned, we're constantly tweaking, adapting, and rolling and moving our hedges around. When the market experiences a period of low volatility for an extended period of time, which deprives us of the opportunity to roll our hedges proactively and be tactical about moving hedges around. If we don't get that opportunity, we suffer much more from this decay, because we can't we have a melting ice cube and we can't juggle it. When the markets start to move around, then we can move our hedges around. We can extract some value at the margin and tweak things to minimize the decay. The decay never goes away, but we can minimize it in a more volatile market. So the kryptonite for us are periods of low volatility. No question. And so just to further the point, I'm riffing on the quote from Hemingway, how did you go broke slowly and then very quickly? This is the go broke slowly strategy. Because of that time decay, it works slowly. And if we go through a long period of no volatility, it'll grind away at us. But because we own the optionality, we tend to be much less vulnerable and very invulnerable, frankly, to shocks, as you saw with historical performance. It's the go broke slow strategy. And if you believe that the market is going to be very stable and benign under continued Fed influence and fiscal influence for a long period of time, then that's conceivably a period where we're going to struggle a lot more.
And what keeps you up at night?
Well, what's interesting is when we have low volatility, that keeps me up at night because I have to manage this decay, and it goes poorly, frankly. I don't worry about systemic shocks or geopolitical shocks. I mean, worry about them as a human being. Obviously, I don't like to see them happen. I don't root for them. But as we saw with the COVID experience and what have you, from a risk perspective, we are we're to borrow from Nassim Taleb, we're fairly anti-fragile. We have the fragility of our equity book and the anti-fragility of our options book. And so when you have a shock, the anti-fragile asset does well. And so I don't worry about shocks. I worry about a market which sort of goes to sleep, if you will, and is too quiet.
Are there any capacity constraints with your strategy?
Not for a long time, Denny. We invest in listed equities. The smallest, I think, in our portfolio is about a 500 million market cap. There are a few, actually. There's a couple of ones that are a little bit smaller than that, but they're tiny positions. In terms of mainstream positions, the smallest is 500 million market cap. The options markets, as I said in the formal presentation, are now the most liquid markets in the world. The volumes are extraordinary, and for a small fund like us to maneuver in that space is we're invisible. We're invisible, and so this is not a capacity constrained approach.
Can you share a little bit of your portfolio holdings?
Absolutely. Could I share my screen again? We could buzz through them, if possible. We'll try to. Okay. You see that?
Yep. I see your contact us page.
Yeah. Okay. We're just going to go to slideshow, and then we're going to shoot forward here. So, and again, we'll share this with people. So this is at the end of the second quarter. Obviously, we're ending the third quarter today, and we'll update this, but I didn't feel appropriate to share it today because our investors haven't seen it yet. So this is a bit stale, but as I said, we have very low turnover in our equity book, and so this has not changed all that markedly. So these are the largest holdings, the largest being the anchors, Brookfield, Fairfax, Berkshire, and we go down from there. Things that have grown, we now have a significant position in the European super major energy companies, which are very cheap, the largest being Shell, but we also have positions in BP and OMV. That whole sector, the energy sector, is a very interesting play right now because it has been left for dead by investors. It's been somewhat capital deprived by ESG concerns and left for dead by investors. And now we have, it looks like, a brewing energy crisis in Europe, which may well extend beyond Europe and in China, I might add. And we're seeing significant strength in traditional energy, and these companies are trading at absurdly cheap levels. If you look at the portfolio allocation, again, it hasn't changed that heavily, but because we have a heavier value orientation, you can see that the constituents in our portfolio are what are now the value sectors, and which are the cyclical sectors: financials, materials, energy. We are weighted that way because as value investors, that's where things are, generally speaking, much less expensive. And a word about this, in terms of recent behavior in the markets, and I should highlight for everybody in attendance, we have more detail on all of our holdings in here, which you can read, and we're happy to put you on our quarterly circular where we have extensive write-ups on all these companies. But an important thing to consider, if I may just jump forward a couple of pages, is the other thing that keeps me up at night, just to go back to your previous question, is as value investors, we tend to suffer when growth outperforms. And so looking over the past year on this chart, the blue line is the ratio of the S&P Pure Value ETF to the S&P Pure Growth ETF. That did very well through the second half of last year and well into the second quarter of this year, and then rolled over the last 4 months. Value has struggled again the last 4 months. We tend to struggle when value struggles because that's our long book. Whereas our hedges are exclusively in the S&P and the NDX, which are now growth dominated indices. We use them because they're the most liquid, but they're growth dominated. And by nature, we tend to be more short delta. And so if the growth indices take off, our options book will suffer a bit more. Meanwhile, our value is underperforming. So the last few months here, we've suffered a little bit because of this value pullback.
Thank you. What attributes do you look for in your equity investments?
So, value investing isn't rocket science, and I think everybody's well familiar with the features of traditional value investments. But one thing, and I alluded to this in the presentation, is we are very keen on committed management. And I mentioned we love firms where the founder is still running the firm and ideally is still owning shares. And so names in this bucket, first of all, you can start with Warren Buffett, although he's certainly pretty close to the end of his career, clearly from his age. But you can go down the line to Prem Watsa at Fairfax. When Fairfax was very cheap about a year ago, he invested, I think, 125 million of his own money buying additional shares, and he's already obviously a huge shareholder. All the way down to smaller companies. Altius Minerals in St. John's, Newfoundland was founded by Brian Dalton when he was a university student. 20 years later, he's still running the company. He's still a young man, and it's his life's work, and he's a major owner. Joel McLeod at Tidewater Midstream is his second company. He's still a young man. His first was a huge success, and he sold it. And when the stock was very depressed a year and a half ago, he accumulated more shares. When you see founders still running their company and still owning shares, to me, there is no greater buy signal. Dream Unlimited, real estate company based in Toronto. Michael Cooper owns 44% of the company, I think. Now he just went from 40 to 44%. These people are 100% committed to their companies. And that, Denny, back to the previous question, allows me to sleep at night because I know they are so heavily financially committed to their companies that every ounce of their effort is going into the success of those companies. And I sleep better at night knowing that. And I hate situations, conversely, where executive officers are getting option grants and they're monetizing them right away. It's just such a disappointing thing to see. I look for the opposite. I want to see owner accumulation. And
something you got wrong that you can share with us?
How much time do you have, Danny? So first of all, I mentioned we still have value growth on the screen. I certainly didn't see the redux of growth the last 3 months, which was very much happened in tandem with a flattening again of the yield curve and the pullback in rates. That is something that hurt us, and I probably retrospectively should have reduced exposure somewhat to value a number of months ago. But again, as long-term investors, we're not tweaking our long portfolio that aggressively. We're very much looking to hold it for a long time horizon, and so we don't tend to trade it tactically. Bigger picture, when you're doing thematic investing, I think with anchor investing, you're typically buying a company you studied for a long time and it gets cheap enough and you buy it with confidence. When you're doing thematic investing, the question you have is, do you have the theme wrong? Is your thesis for the revaluation of the sector just wrong? And 2 years ago, I made repeated attempts to get long energy, which I was convinced was bottoming. And I think 3 times that year I had to stop out of position because I was just proven wrong repeatedly. But the critical thing in investment, as in trading, is stop out of your positions even when you're convinced you're right, because if the market is telling you wrong, you're wrong, and respect price and live to fight another day. And so that's very much a mantra.
And your fee structure, if you can share with us.
Absolutely. So I'll just put up the summary fun facts here. So our fee structure is a management fee of 50 basis points, which is deliberately modest because I think I mentioned earlier on, our core investors, core stable investors are local high net worth clients. And our proposition to them is we don't get paid unless you make money, very simply. And that's something they understand and they appreciate. So we have a very low management fee and we take a 20% performance fee above a perpetual high water mark. Again, it's Canadian investors only. We're presently available in Ontario, Quebec, Alberta, and BC. We can add other provinces very easily, but because of our size, we sort of manage our costs and our focus. We try to be as focused as possible.
Maybe I will ask you my last question here. The returns look to have been a bit weak in the last few months. Why do you think that's going on?
Well, just back to my previous point about growth versus value. And that's been a driver the last 3 months, 4 months. This rollover in value has caused us the long book to lag significantly and the hedge book to underperform because it's growth dominant. I read an interesting report from Research Affiliates, Rob Arnott, recently, who is very quantitatively driven in his analysis. And it's his conclusion that value is presently in the cheapest decile it's ever been as a spread to growth. And in fact, I think he said it's in the lower half of the cheapest decile. So whatever the term is when you divide deciles into 20 pieces as opposed to 10, it's that cheap. And so it does, I think, corroborate our positioning, but it means in the short term, we suffer again when value underperforms.
Thank you. Somebody's asking, option strategies are defined by strike levels of hedges. How do you think about hedge price level?
So we're constantly assessing. I'll stop share so there's a bunch of different factors that go into our hedge decision at any given point in time. And the complexion is constantly changing. But one is, given our risk profile, given market condition, where do we perceive the risks to be? And once we've identified those, how can we most inexpensively try to sterilize that risk? And that's going to be a function of the shape of the volatility curve. There's a term structure to volatility where you pay more for longer term options, certainly, than shorter term options, which is sensible, but that premium varies. That's a term structure. And there's also what's referred to as skew, which is the relative cost of out of the money options as compared to at the money options. Depending upon term structure, depending upon skew, depending upon our market view, and depending upon our risk profile, we will tweak our hedge book to try to position it in the most inexpensive way possible. But it's dynamic. Up until very recently, up until the market's been a little bit weak the last week or 10 days, the term structure of the volatility curve is very, very steep. And so you paid a big premium to go out further. So we tended to have our hedges in a little bit closer than I would typically like. As the term structure is flattened with the sell-off in equities, we've been pushing things out because it's been cheaper to do so. I hope that answers the question. I'm happy to take it up after offline.
If anybody would have any more questions, they can definitely reach out to you directly. Someone is mentioning here, in my humble opinion, the Fed has two options, probably about the situation right now, either to sacrifice the dollar and let the inflation run, or taper and send everything tumbling. Just an opinion of someone here. Is there anything else that you'd like to add beyond everything we talked about?
No, thank you. thank you, Denny, and thank everybody for listening. And we'd be delighted to speak further. And I appreciate everybody's time.
Yeah, and I want to say a couple of things. Just next week is a very special week for us. It's the Canadian Online Family Office Conference. We've done that last year as well. And due to a high demand we're seeing here, we decided to open a second date as well. So next Tuesday, October 5th is the first date. And 20th would be the second. We have amazing speakers like Patricia Saputo, like Ron Sean, who's a next gen of a major real estate family from Vancouver that invests in technology. Saputo is from Montreal. Frank Odea, who's the co-founder of Second Cup. Kathy Asayag from the Jewish Community Foundation, Montreal. Michael Kanfi, that did one of the biggest exits in Canada with Image. I believe that was the name, right? Image. I don't have it for me. Anyway, an exciting fellow that we'll do a discussion with later on. And Miles Nadal, who's a very known philanthropist and businessman from Toronto. And loads of names, as you can see here. Our partners are Scotia and Fasken, Real Ventures, and great firms that will be joining us. De Gaspé will be speaking as well. And Susan Kichuk that will talk with us about different strategies in insurance, and Peter Nicholson. So it's going to be a big party all day long, October 5th. So stay with us, join us, and then again on the 20th. So we are all Canadian this month, it seems. And I hope, Philip, you'll join us as well.
I look forward to it.
And thank you, everybody, for being here. And again, you will get by tomorrow, this time, the link to this recording and the contact info to speak to Philip directly. And for those of you who are not here, you will also get that link, but you don't know that yet because you're not here. But when you see the recording, you know that. That's my humor. Anyway, thank you all for being here today. See you later. Philip, thank you so much for your time.
Thank you, Danny. Thank everybody.
I'm looking forward to seeing you in person.
Likewise.
Thank you.
Take care.
Bye-bye.